It's February the 8th, 2010 as I record this, and it's my belief that the stock markets have now finished their rally that began in March of last year and are now set to recommence the bear trend as before. I've never quite believed in this rally, to be honest. I've always figured it was a bear market rally, and I think there are a number of compelling factors that I'm going to show you in this video that would lend evidence to the idea that at least it's over for now. So what you're looking at here is the 66% price extension from this low, which was 6,470, the low of March 2009. That's that price, 6470. 66% of that price projected upwards comes in as a target, and we pretty well hit it. And interestingly enough, if you also took this low of the first major correction and projected up 33% from that low, you'd get the exact same number, because in fact these two are actually related also in price percentage, so you get the same number coming in. So those are the kind of GAN price targets, but even with more conventional Fibonacci levels you can see the same sort of thing. So for example, going from all-time high to recent low of March, we get roughly a 50% retracement. It's traded through that and it doesn't look very convincing. However, if you then examine this set of highs here versus the low, you notice it's much closer to where our recent high took place. If you move this down to the next high around so, this one, down to the low, you see again that we've got, this is the 764% of that total move coming in at roughly the same level. So you've already got two Fibonacci type levels plus two GAN levels that I previously explained, giving you roughly the same zone. And there's even more to say. The trend line, and this is the daily Dow Jones now, we were just looking at the weekly, the trend line that very nicely defined the uptrend right up to this little movement at the climax has now been very decisively broken, as you can see, for the first time since it began. And so again, that's pretty strong evidence that at the very least we're going to see a very strong correction, if not an outright reversal of trend. So now we're looking at the daily chart, and we see three black crows, three down candles in a row from the high, and this is a signal I look for very often as a very major bearish signal, and it's occurring off of the high, which was formed at major resistance levels, as we just discussed. And when the rally comes, it's just a weak little two-day rally, which is actually just a 382 Fibonacci level, as you can see there, and consequently one of the weaker retracements, and thereafter the market collapses again rapidly. And in fact it's collapsed down to a support level which is 8.33% from this price projected down, as we did earlier with the 66% I showed you. And so it's found a reason to stop. But my belief is that it will just rally for a few more days, perhaps rally as high as this high here at 10,314, and then be primed to trade further down. Certainly I wouldn't be looking for the uptrend to in any way resume unless you have taken out that resistance I showed you on the previous chart of 10,782, which is above the high that we've seen, because we would have to take that out completely, all those resistance levels, to say that the uptrend is safe to continue. And certainly from the look of this sell-off, that doesn't look like it's going to be happening, because you have to also remember that this sell-off is happening faster and in a more severe fashion, points wise, than previous retracements before it. So those are the reasons. Also you get cycles impacting at this high. Quite a few GAN time cycles come together here. For example, just a couple of days before the high, trading days before the high, on the 15th of January, we were 45 weeks exactly from the March low, and that's a very, very, very important number in GAN cycle terminology. So that impacted literally about 2 days before the final high. And on the 11th of January, literally a few days before that, we were exactly 720 calendar days from the January, I believe 22nd low of 2008. That's the first major low after the final high of October 2007 was formed. And finally, one other thing that's of slight interest to me is this. When you take the 618-day moving average, which is a Fibonacci number, and project it onto the chart, that's what you get. It comes in right where the high was formed. I know that's a weird number, but that's one of those Fibonacci numbers, and I sometimes like to throw them in to the moving averages to see if there's any validity, and it certainly seems to have some validity right here. And if you do the same thing on the S&P, you get the same effect, even more precise. So I think there's something going on there, definitely, with Fibonacci numbers. I don't think you've ever seen the 618 moving average before, but it's something that is something I like to look at anyway every now and again. So there you have it. In summary, I think the uptrend is over and the bear trend is resuming, and where would we expect it to go? Well, probably back to the lows, and I would think that the chances are that it'll be a fairly rapid move. The whole thing is, of course, negated if, as I said, we take out this level here, 10,782, in a definitive fashion. Then not only is the old high taken out, but also some of the resistance levels that conspired to produce this high, as we previously discussed. So that's what you have to see taken out for this view to be negated. But failing that, I would expect this whole thing to collapse very rapidly now. So this is Asoka Salvaraja of OnlineTradingRebel.com. Thank you for watching, and goodbye.